And we'll move on. The next issue is going to be the United States dollar. Again, this is now becoming important to observe because of what's happening with yields. You just reiterated earlier that yields, short-term 2-year yields, bond yields are up or are spiked. We did the longer-term technical picture, of course, yesterday. We now understand that on that daily chart, we're doing another head at least. We're broken out of that diamond, and even if we were to retract back on a correction, what this chart means that you always want to buy at that neckline is going to be 114.46 or around these levels with a stop below that inverted head and shoulders. You're seeing, of course, a massive inverted head and shoulders at that point. We just have a stop below that left shoulder. That left shoulder comes in at that right shoulder, I'm sorry. That right shoulder comes in at 113.2 or 113.4 actually. We always show these charts because they show opportunity for intermediate term investors. We call them investors, but they're not really investors. They're intermediate term position traders. So if you're an intermediate term position trader, you would want to look at the pivot levels, the monthly pivot levels, and always buy, seriously, the lower spectrum of the monthly pivot levels. So if I were looking at the monthly pivot levels for the United States dollar against the yen, maybe I'll get to see, I don't think we're showing these today. We're not showing them. I'll get to see that, say, the breakout low is 113.5, that the fluctuation low is 114, for instance. So I don't want to really bother my head with all the following up of the market and making all the technical entries and monitoring on a day-to-day basis. I'll just have to do two things. I would have to look at a chart like this. Okay, so this chart just shows a green arrow and a red arrow. It shows that you're probably going to get 114.4, maybe even on that one day, on that next 1 hour chart, you're going to get 114. Okay, so I will just leave an entry at 114. I know that I have a stop at 113 or 113.4. So it's now a position investment or a position term investment. Okay, according to this, you should just let it run towards the end of the month. It's going to be 117, 116.8, whatever I get at the end of the month, I just close out. I'm not there most of the time. I'm able to actually reap yield because of the positive momentum that I'm seeing, or that I'm told is there on the 1 hour and the 4 hours and all the higher degree time frames. Then of course I'm buying into a trending market. I'm buying into a rising market. I don't have to bother about anything else. I don't really have to bother about the entries. I don't have to squeeze my brains about them, because they don't really make much difference. If this is correct, if I get filled at 113.9 or 114 and 114.10, even 114.40, if the market is going up anyway and the breakout low is around 114 and 114.40, then a stop below the breakout low is fine, excellent, and I'll just go for the breakout high on a monthly basis to be efficient. Okay, so currently what our current chart is showing is this is what we're seeing right now in the market. Market actually did 114.9. This market did exactly 114.9, and we are moving inside of this ending diagonal. We expect a retraction back towards the ending diagonal. As technicians, we are of course short-term traders, so we are invested elsewhere. But the opportunity here is too good to pass, actually, because of the momentum plots. So we're going to have a correction at some point. That correction is going to take us to 113.9, 114.10, 114.20. And that's what we are showing on this 1 hour. We're looking to buy 113.9, 114, and 114.15 or 114.20. Stop is just 113.2, this level here. All right, next target is going to be 115. All right, you could see seriously this target within, we think, something like 2 days, 2.5 days. It's an intra-week target. Of course, we're going towards the end of the year. It could be a plus or a negative. A plus meaning that if there's thin volatility, the market will move very suddenly, spike higher to take out stops or take profits at 115. If there is very low volatility, of course, we could just get stuck into that position all the way into the next year, which is very soon. All right, so entries are again swing and intra-week trades. We would want to buy 113.9, 114, 114.10. These three levels here at the moving average on a correction down at that green arrow. We take this to 115 and then we curve the trade maybe sometime next year. We confirm that we have broken out of this diamond, and as suspected on strong, this is misspelled, sorry, bond yields. So there is now strength in the short-term end of the bonds. Would mean that there's going to be short-term interest rates, could be, there's a threat of short-term interest rates rise, so that the yield curve is not inverted, and therefore this is driving the market up. We have, of course, we'll look at the longer-term momentum plots. We have a trigger on the 4 hours. That's why it's always appropriate to buy 114.10 with a stop below level 2 altogether. Over here we're showing 112.5, but in reality you just want it to be below level 2. The trigger is in that one too. So in reality you're looking at 113, 113.2. This level 2 becomes key. All right. For longer term traders, it's not only going to be 111, you can get 115, sorry, target. We expect a lot of choppy action, but if yields suddenly spike higher across New Year's Eve, you would want to let the trade run, because the target is not going to be at this yellow arrow 115 as already outlined for the short-term intra-week trade or intermediate-term intra-week trade. It's going to be another head 115.8, maybe 116.6 or 116.5. These are level 5s as outlined here on that 4-hour chart. Momentum plots on all other time frames are very strong. Daily is very strong and rising. Weekly is excellent. So we are in a degree 3 on the weekly. We seem to have finished a lengthy degree 4, internal degree 4 correction. We're now in level 5 of 3. Projections are 116.10 and 117.